Good morning and welcome to this Monday, April 24th, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we escaped options expiration week last week relatively unscathed. I always worry going into option expiration week, especially when we've got our major indices and the ETF that track our major indices that are trading well above max pain level. And those of you who may be unfamiliar with max pain, that of course is the point at which the market makers inflict the most pain on options traders. So it is the point where they pay out the least amount of premium. And that level was 3%, maybe up even close to 4% below where the S&P 500 and the NASDAQ 100 were trading going into last week. So I always look at that as, hey, we could be in for a 3 to 4% decline. And we didn't go down like that. We went down a little bit. And I do, always say that I use these max pain clues as directional clues. I don't use them as guarantees that that's where we're going. What it tells me is that there is financial incentive for market makers to sell stocks last week. And we saw some of that. We didn't see a lot of it, but we did see movement back down. And so I think max pain did its job in terms of giving us a pretty good directional clue. Also, our major indices were up against some key price resistance. So breaking through that resistance didn't seem likely given the fact that the options premium would have just continued to go higher and higher as prices rose. So we did hesitate last week, which I think was kind of to be expected. And we did pull back in some areas. It did live up to the what I like to call opposite George week. If you're a Seinfeld fan, you know that with opposite George week, Jerry Seinfeld's telling George Costanza that, hey, if everything you do in your life is always wrong, if you're always making the wrong choice and you're always doing everything wrong, just do the opposite. Whatever you think you should be doing, just do the opposite. And so he starts doing that. And it's a pretty funny episode, but if you like the Seinfeld humor. But anyway, he starts, changing everything he does the opposite, and his life starts turning around. Well, in the stock market, the analogy there is that whatever is working going into option expiration week, chances are probably isn't going to work option expiration week or even into the early part of the following week. And so for April, the storyline was communication services. Communication services has been leading the market to the upside for the last three and a half, almost 4 months. I mean, year to date, communication services, best sector. Last week, worst sector. Went from first to worst as options expired. But that's because as the group's been going up, you have a lot of individual stocks within that area that had a lot of in-the-money call premium. As traders were bidding up, and buying call options on any stocks or on stocks within that area of the market, they were seeing their profits go up, 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 up because the stocks kept going higher. Well, in option expiration week, you got to be careful because market makers can pull the carpet out from under you. And a lot of that option value can go bye-bye. And so again, not shocked to see the XLC, the communications services sector, underperform last week. Anyhow, let's go ahead and jump in here. We got a lot to go over. I got a busy week ahead. I'll talk about that a little bit. I do want to mention to everyone that we have, first I'll be guest hosting the final bar over at Stock Charts TV. I'll be doing that for the next 4 days, Monday through Thursday. Dave Keller, who normally hosts the final bar, will be he'll be at the CMT conference all week. He's going to broadcast live from there on Friday, but Monday through Thursday of this week, I will be subbing for him. So if you want to check that out, actually, if you go over to Stock Charts TV and just click on that link at 4:00 this afternoon, and on each afternoon, 4:00 Eastern, literally as the market closes, click on that, and you'll be able to follow me there on Stock Charts TV and doing the final bar. Very simple. You don't have to be a member at Earnings Beats or at Stock Charts. Just simply click on that Stock Charts TV link at 4 o'clock, and you should be able to come right in. Listen. Also, later today, I'm a glutton for punishment. We are going to have our Q1 earnings webinar. That will be at 5 o'clock. So final bar will end at 4:30, and I'll try to get my voice ready for yet another webinar at 5 o'clock today to go over what I think are some of the more premier earnings reports that we should expect throughout the rest of this quarter. I will also go over some earnings reports that I don't like as we go throughout this quarter. It will probably be a somewhat briefer webinar than I normally have done in the past with these, just because I'm not sure my voice will hold up for all of these webinars today. And I also may have to do a 4th webinar tonight, because I always record for Tuesday morning over at Stock Charts. This same show, Trading Places Live, is over at Stock Charts TV on Tuesdays and Thursdays. And so I either get up, do it really early on Tuesday morning, or I do it at night. So it's possible if I do it tonight, I don't know that I'll have the voice for it, but if I did, that would be 4 of these webinars today, which might be a little ambitious. Anyhow, looking at the market, let's take a look at what happened on Friday to close out last week. Saw the Dow Jones up 22, S&P up 3, NASDAQ up 13, mid caps down 1, small caps down 4. Pretty much nothing. And if you look at the last week, the Dow kind of drifted a little bit lower. The S&P 500 drifted a little bit lower. The NASDAQ drifted a little bit lower, maybe a little bit more. Mid caps just kind of going sideways. Small caps drifting a little bit lower. But as you look across all of these major indices, there was short-term and sometimes more intermediate-term resistance that we were facing going into last week. So small caps, you can see the high there, probably around the 1190 level. Going into last week, we were probably 1180. So there wasn't a whole lot of room to the upside before we hit that overhead resistance. Same goes for the mid caps. The early April high, you can see we're right up against it, unable to get through. We also have the 50-day moving average. Then we look at the NASDAQ. We had the February high, then we had the late March, early April high, and then going into options expiration week, we were literally sitting right against that resistance, and we pulled back to the 20-day. S&P 500, same thing. I think it's like 4175, 4180, something like that. That's what we're looking at as overhead resistance. We came into the week right up against that level, and we pulled back about 1% last week, maybe just a little less than 1%. Actually, it was just a little bit, it was fractionally lower. I think the S&P was only down like 0.1% for the week. But you can see that the trend overall was back to the downside, especially from earlier in the week when we were up a little bit. Dow also, you can see the resistance going back into January and February, just sitting a little bit above where we were to open this past week. So I think the market did probably what most would expect it to do, at least most that are aware and knowledgeable about option expiration week. This isn't something new. I've studied the S&P 500 since 1950. The 19th of the calendar month through the 25th of the calendar month is the period where we typically see weakness in the stock market. Now, there is an exception to that when the market is going down heading into option expiration week. Sometimes the market will get a lift, but historically, the market has gone up much more than it's gone down in the week leading up to options expiration week. So as a result of all that, we do expect normally for the market to pull back. Last week, we do have, I mentioned the 19th to the 25th. Today is the 24th. Tomorrow is the 25th. So I just kind of, I'm aware of that. I mean, the market may take off and break out, but we may also see some weakness here early in the week, especially leading up to some bigger tech reports later this week. I know in our portfolios, I think we have maybe 6 or 7 of our 30 portfolio stocks that will be reporting this week, including Meta. So there are going to be some big reports coming out this week, and much more geared toward technology. Where as we go through this week, and especially next week, we're going to start seeing more and more and more technology companies coming out, and communication services and discretionary stocks. And keep in mind, these are the three groups that have been leading the market. Last week, with a lot of the weakness that we saw, and a lot of the earnings that we saw, it was in the financial area, or at least the earnings were. Sometimes we actually saw many of the financials that had been beaten down so badly, it was almost like sell on rumor, buy on the news, because a lot of these banks that were beaten down reported not so great results and still bounced. Some of them bounced pretty nicely. So the composition of the earnings reports is about to change. That's my point here. We're moving on from a lot of the financials. We'll still have some financials reporting this week, but it'll start to rotate more and more to some of the aggressive areas of the market. And I think that is going to be critical, how these stocks react to their earnings and to their guidance. I think this is going to be a big reason that we either make our breakout, a big breakout, and I'm talking about a very significant breakout above last August's highs, or whether we roll over. Got a lot of folks still very bearish in this market, thinking we're going to roll back over. I think probably the next 4 weeks, 3 to 4 weeks, is going to tell us a lot about which way we're going. Anyway, as far as sectors go, at the end of last week, I do want to point out consumer discretionary, consumer staples were the leaders. Healthcare also had a strong day on Friday. Lagging, though, materials and energy. Materials down almost 1% on Friday, back to test their 20-day moving average. Energy finishing almost squarely on its 20-day moving average as well. That was down about 0.6%. On the flip side, we saw staples breaking out. We saw discretionary moving up, approaching some key overhead resistance, but not yet breaking out. And healthcare bouncing from just above the 20-day moving average. One thing I will show you, though, I think is really important. I've been talking about this for a year, actually maybe 16 months. The AD lines. Look at every one of these groups, whether they went up on Friday or down on Friday. AD lines, new high, new high, new high, new high, new high. A lot of the weakness that we're seeing when we do see weakness is at the opening bell, early morning action. We are seeing plenty of buying throughout the trading day, and especially in the afternoons. And it's going to be hard to convince me, watching the stock market moving up now, coming out of a highly manipulated period in 2022, as far as I'm concerned, watching the market go up, watching price action remain above key moving averages, watching the AD lines soaring. It's going to be hard to convince me we're going back down. Hey, it can happen. I'm not telling anyone that I have a guarantee for anyone. I'm giving you my signals. I'm giving you what I'm seeing in the market. Some label me as perma bull. Honestly, if you listen to me, if you've been listening to me for a while, you know that's not true. I am going to be bullish a lot more than I'm bearish, because the market goes up more than it goes down. I'm not one of these guys that are going to always say the sky's falling. That's what you're looking for. You're going to have to find someone else. If I think the market looks bullish, I'm going to tell you it looks bullish. But a little over a year ago, back in January 2022, I was one of the first talking about a bear market long before we saw anything close to a bear market. I said the conditions were ripe. And one of the analogies I always give is that you don't need to have a tornado in your dining room to know the conditions are worsening. You can look outside, you can see some really big storm clouds coming. You don't need to see that storm in your house knocking off your roof to realize you have a storm coming. And that's what I talked about at the beginning of 2022. The storm clouds were out there, and it was just a matter of whether or not we started to get price confirmation. Once the price confirmation hit, there was nobody more bearish than me in 2022 for the first half year. Every rally, you can go back and watch my videos. Every rally, I said, nope, this isn't it. This isn't it. I think it was in May, I finally started saying, okay, we're getting closer and closer to a bottom. And then mid-June, I called a bottom. Late September, I called a double bottom. Early October, we went a little bit below. temporarily and then rallied back, and we haven't looked back. So I've been on both sides. I'll call both sides. I'll call what I see. What I see right now is telling me stock market's going to go a lot higher. A lot higher. Let me repeat that. A lot higher. Anyway, and we'll see. Time will tell. There were people thought I was crazy when I was calling for a bear market when the market was barely down. I wasn't really calling for a bear market. I said conditions were such that the risks were too great to be on the long side. And that worst case scenario, the S&P 500 could drop to 3,500. We went to 3,491. That was the low. So I just give you what I see in the market. You can do with it what you want. You can disagree. You can agree. That's completely up to you. All right. Anyway, 10-year Treasury yield. Let's get the update here this morning. Currently, we're at 3.53%. We're down about almost 4 basis points. Nothing really in terms of economic reports coming out today, so we don't really have to worry about that. A couple of key reports to at least be thinking about later this week. We do have the Q1 GDP, the first estimate, coming out on Thursday. And I don't really pay as much attention to that as a lot of folks. I think it can be a stunner because the first one, you never know quite. You know, we got a lot of estimates, but it could be way off, could be over, could be, shy of expectations. But the way I look at it is it's telling you what happened in the last quarter. The stock market prices in what's going to happen over the next 2 or 3 quarters. It really doesn't care about what just happened in the last quarter. All that has already been priced in. So I think any kind of big news surrounding the GDP just becomes, clickbait for media headlines. That's all. GDP tumbles or GDP falls way short. Those are, you'll definitely be seeing those if GDP comes in shy because everybody's thinking recession. So that would be big news. That would be really big clickbait. Stock market's looking ahead. It's not looking behind. Anyway, new home sales will be out tomorrow. Personal income and spending come out on Friday. And with that is the PCE price index. That's something the Fed watches pretty closely in terms of inflation. I would be watching that report on Friday. That is one that I think could move the market. I think consumer sentiment, I didn't write it down, but I think consumer sentiment also comes out on Friday. That will be an interesting report to watch as well. All right, let's move on. Talking technically, S&P 500, I really don't have anything much more to add. I just talked a lot about the S&P pulling back. There's your overhead resistance from February. There's the big daddy of them all right up there in mid-August. That you break through 4,300 with any kind of confirmation, and that, I think, puts the final dagger in the bear theory, the bear market theory, because that, on a longer term basis, is the lower low. There's your lower high right there. There's your lower low. And everything that has taken place since October has been between that high and this low. So it's really simple from a long-term perspective. Which level gets taken out first? If we move back up through 4,300, to me, that is the last piece of confirmation I need. I've got signals telling me we're already in a bull market. That would be the confirmation. That would be the nail in the coffin. If you're on the bearish side, what you're looking for is a breakdown below 3,500, which was the low back in October. Hey, granted, we have not taken out 4,300, so that low still remains in play. You won't hear me say that it's not in play. I just don't think we're going back down there. NASDAQ 100, pull back. Last week we pulled back. A lot of times I say when we talk about max pain and it looks like we can get a pullback, and I start talking about a directional clue, and I'll say, if the QQQ or the NDX, QQQ tracks the NDX, but if either of these just pull back, move directionally lower to the 20-day moving average, first of all, from a technical standpoint, that's normal. 20-day tests are very normal during uptrends. And the move lower would help market makers save millions and millions, perhaps billions. across all the different market makers. That's what the lower prices heading into options expiration. All of a sudden, if you've got, let's pull up the QQQ. Let's say you got the QQQ 320 call. Early in the week, hey, you went up to 321 and change. It was like, hey, you got things brewing. Well, by Friday, it expired worthless. What if you went in early in the week and you had a 315 call? You were up $6, $7 in the money. By Friday, you were $1.60 in the money. And intraday, you were down to 314.10. Intraday, that 315 call was probably getting close to very, very little in terms of value. Probably 30 cents, 50 cents. I don't know. But that's what happens, just those little subtle pullbacks. And market makers have a windfall in profits. It's another little TARP. If you remember the TARP back in, what was that, 2009, 2010? All the banks having all those issues. So the TARP came out, which basically just gave them a bunch of money, keep them solvent. Well, sometimes max pain, options expiration week, can be a form of TARP for a lot of these financials. All right. So I wanted to go over the chart of the day. Before I do, if you do like, getting things that make you think a little bit, maybe give you trading candidates from time to time, go over to earningsbeats.com, scroll down. We have an Earnings Beats Digest newsletter. All it takes is a name and an email address. It's completely free, no credit card required. You can unsubscribe at any time. Just go over here, scroll down, put it in, subscribe, and you will get things like what I'm about to show you, which today I wrote an article over the weekend about the VIX in my Trading Places blog at Stock Charts. Probably can show you real quick. If you go over to articles, and you will see, is the bear market over? Watch the VIX. There's an article I wrote yesterday morning. And you can go ahead and take a look at that. But at the end, I just made a comment that, hey, is the stock market overvalued? Is it overvalued? And I guess there are a lot of different ways that we could look at that. Hold on one second. All right, thanks. There's a lot of different ways that we can look at this. And what I did first is I just said, okay, where is the S&P 500 gone? What have we truly earned on the S&P 500 this century? And the way you can look that up is, first of all, I went out on I did a chart of the S&P, 75-year charts. This goes back before 1950. And it's a monthly chart. So you can actually see, gives you monthly activity here on the price chart. And then down below, I did a rate of change, 280 months. And if you're wondering, well, how'd you come up with 280 months? Well, for 10 years, it's 120 months. For 20 years, it's 240 months. And then I needed another 3 years and 4 months, which is another 40 months. So I take 240, add 40, and I get 280 months. So that gives me roughly the change in the S&P 500 for the last 23 years and 4 months. And what I do is I just compare it. This is where we are right now. Over the last 23 years and 4 months, we've gone up 180%. Now, normally, throughout the last 75 years, we go up an average of 9% every year. And if you did 9% every year and you compounded it over 23 years, trust me, it's a lot higher than 180. If we just add up 23 years, it's more than 180. So when you start doing the compounding, it really, I don't know what the number is. It's probably somewhere in the middle of all this. So I'm going to guess maybe 700-800% would kind of be the normal over 23 years, 4 months. And we're sitting at 180. We've gone up 180%. And so that over the last 23 years and 4 months, we are way below the historic average on growth of the S&P 500. So when I look at this chart, and as you get to the late 1990s, by the way, when the last secular bull market ended, we were at, 1998 hit 1,500. By 2000, it was around 1,400. But you can see where we are when we look back 23 years and 4 months from the ultimate top in a secular bull market, because a lot of people were trying to say that the end of 2021 was the end of the secular bull market, and now we're into a secular bear market. And I want to just show you how ridiculous I believe this story sounds. So here's what we did in 1999, 2000. We got up to 1,400, 1,500%, which was probably double what we should have done over those 23 years based on that average 9% a year return. We went too far. We went way too far. If you look back into the late 1960s, here we got up over 1,000% for that 23-year, 4-month period. Over 1,000%. And if you look, well, this was in late 1965. We had a couple peaks that went up a little higher, but for the most part, this was a broadening pattern or a broadening top, kind of where we were going up, higher highs, higher lows. We just went sideways for the better part of 12 to 14, 15 years before we finally started moving up again. At the end of the 1990s, we basically topped, and we didn't set another significant new high for 13 years. That's what happens when you go too far for too long to the upside. Now, I want you to look at this and tell me why you believe we're so violently overbought. I think we are sitting in a very similar position to what we saw after the 1987 crash and even into the early 1990s. We were sitting at about 250%. Here we're at 180%. That was only 8-10 years into the bull market. This is only 10 years into the bull market. The bull market started in 2013, right here. That's when we took out the double top and moved to new highs. So that was the start of the secular bull market. 1982 or early 80s is where we took out the prior highs from the 70s. So again, early 1990s, we were 10 years in. We had only gone up about 200, 250, 280% over the last 23 years. Why? Because we already had a secular bear market in here for 12, 13, 14 years that was holding down our return. As we started moving out of this period and went into the 1990s, that's when this explodes to the upside. I think we're going to do the same thing. We're going back 23 years right here. All these years are going to start to fall off over the next decade. And when they do, and the stock market goes higher, which I believe it's going to, you're going to see this number begin to jump. I think we're going to probably get to 1,000% over a 23-year period, probably by the early 2030s. And at that point, you're going to want to batten down the hatches. But I think we're a long way from there. Now, I did a couple, somebody could, you could look at this and say, well, Tom, you pigeonholed this 23-year, 4 months. How about, looking at other time periods? And I somewhat agree with that. I mean, I do think that you go through these long-term secular bull markets, which we've only gone through 10 years. The last 2 have been 20 years. So from that standard, I think we do have 10 left. But let's look at a couple of others. I'll just look at real quick. So this one, what did I do here? So I used the rate of change 168 months, which is 10 years. I'm trying to remember why I did. This is 16 years. Why did I do 16 years? I just set this up this morning. It's not easy getting old. Anyway, let's just go with it. Let's go with the 16 years. And you can see, back in the mid 1950s was when we peaked. Into the 60s, actually, peak was around 350. In the late 1990s, we got up to 650, and currently we're at about 450 or so. right? So, oh, I know why I did this. This is 14 years. It's 4 years plus 10. It's 14 years. That's what I'm doing here is I'm going the other extreme. So what I did is I said, okay, let's go back to this low. This has been all since the very bottom of a 12-year, or at this point it was 9-year secular bear market. Let's, instead of saying, going from here is the bull market, let's just say 16 years, or excuse me, 14 years. So 14 years is the entire move here. This is as good as it gets. If you think that pigeonholing 23.4 was crazy, this is the other side of extreme, going from the bottom here to where we are now, right? Well, we got to 440% rate of change, and now we're starting to drop. And the reason we're starting to drop is that we're starting to move into a period where this was going up rapidly. Even if we go up here, we're probably not going to go up as rapidly as we did for the next year from the beginning of 2009 to early 2010, or even into early 2011. I mean, we went up 666 to 1,400. We doubled in 2 years. We're not likely to double in 2 years. So this 14-year rate of change is going to go down, even if prices do go up, right? But I just wanted to point out that even if we look at that, we didn't get close to 1999, which I think was an aberration. I don't know that we'll ever see the late 1990s again. But we also didn't even get as high as we saw back in the 1950s. And again, keep in mind, this is going to go up. So those of you who think the market's going to go down 20, 30, 40% from here, this number probably would go all the way back down somewhere in this range, because as we go up, let's say we go down 40% over the next year. Let's say we go down to 2,500 on the S&P. Over the next year, we're going to be at 1,250 here. So that all that's going to be is a doubling. We'll be up 100%. So this 375 would go all the way down here to 100. And maybe you think that's where we're going. I think we're just starting off on this bull market, kind of like the 1980s. We're starting off. I think we're going to pull back probably for the next year or two, because again, we're going to be rising a lot there. That's going to impact it more. Even if we rise here, it's not going to be as much. So I think this comes down for a little while. But once we get to about 2011, which would take us out to 2025, then for the next couple of years, we go sideways. I believe the market's going to be going higher. And that's when I think you're going to see the next big move up in this percentage. Anyway, the last one I did the same thing on this one. Excuse me. This one I did 216, which was shy of 20 years, would have been like 18 years. I think the reason I did that was to look at the peak of year 2000, because if you go back 18 years, you'll go back to 1982. And that's about when we were starting to break out and move higher. So this is the cream of the crop rate of change if you're looking back to the 1980s and 1990s, showing how ridiculous the valuation had gotten. Now, there are some that say, hey, we're just as overvalued now as we were back then. They start pulling out PEs and all this stuff. And I look at this and I'm like, really? So you think the 18-year move rising 1,250% back in 2000 is the 250% that we've gone up the last 18 years now is the same? This is what we're looking at in terms of overvaluation? Yeah, I don't think so. So anyway, a different way of looking at things, using the rate of change monthly going back a number of years. Listen, you can look at this and say, well, I don't really see any value of it, and that's fine. You can look at it and say, wow, that really put things in perspective. That's great. You can shrug your shoulders and say, well, I don't know. I'm not really going to put any weight on that. I'm just pointing it out. It's just another way of looking at overvaluation versus undervaluation. I think going back to that very first one and knowing right now that from the last 23 years, we have only gone up 181%. To sit there now and say we're 30, 40% overvalued, I just don't see it. I'm sorry. I don't see that. I mean, if we go back 75 years, this 23-year performance is near the lowest we've ever seen. I'm not buying into the valuation, the overvaluation theory. Anyway, QQQ, wanted to mention, actually, this was one I already looked at, I thought. Yeah, we looked at this during the talking technically phase. I want to get an update, though, just kind of see where we are, because futures were pointing to slightly lower open. Actually, we rallied back up. We're up a little bit. I got to say, with market makers having incentive to move prices lower, being up near resistance, and everyone being so negative and bearish, does it not surprise you that here we are still sitting ready? Potentially, I mean, we had a good day today or tomorrow, we could be breaking back out again. It's possible. I look at all these hollow candles. We get gap downs and then we get buying. Anyway, wanted to just take a quick look at Coke. Coke reported. We're going to have a lot more earnings coming out later in the week, but this was a big one for today. Nice gap up on Coke today. We are up about little over 1% on the stock, but we were right near some key resistance coming across here for the last year. Looks like we're gapping up and taking it out. Yet another stock moving up to or near 52-week high. We're seeing more and more and more of them, but still got a lot of folks very bearish, and we'll see what happens from here. Let's just take a quick look at what the market's doing, and then we will head out. I apologize first for going into the open. A little bit of slight green, slight red. The VIX is up 3%, so it is back up over 17. This one, the VIX got a long way to go to really start moving the market. The VIX at 16, 17 is telling us, I mean, the reason I like the VIX, I like the CPCE as a sentiment indicator because that tells us what traders are doing, options traders. There are some good, very good options traders, but the majority are just greedy. Retail traders, instead of just putting their money into the QQQ or the S&P 500 and growing their money slowly over time, a lot of options traders just want to try to retire early. And so they use leverage, and it normally doesn't work out very well. Maybe over short periods of time it does, but over long term, it generally doesn't for most traders. Again, not criticizing those who are really good at it, because there are some that are professional traders, do a lot of options trading. They know what they're doing. They have a lot of perspective. They got a lot of things going in, and they're not being run by greed and fear. So the CPCE is good. The reason I like the VIX is because it's basically priced by market makers. It's telling you what Wall Street thinks of what's coming. And a lot of times the VIX and the equity only put call ratio go opposite directions. And that's what we've been seeing. We're still getting some fairly bearish readings on equity only put call ratio from time to time, especially if the market pulls back at all. But the VIX has been dropping. Market makers, and I talked about this back in December, market makers are telling us that this market is not going lower. If it was going lower, you would see the VIX priced much higher. Options would be priced much higher to account for all the volatility associated with selling. When it gets down, back down into this area, that is a good sign for the stock market. I'm going to leave it at that. Already gone over. Again, later today, I will be subbing for Dave Keller for the final bar. So if you would like to hear my wrap up of today's action, that will be on Stock Charts TV at 4 o'clock Eastern. Just go in there and click at 4 o'clock and you can listen in. I'll give you my take. Later this week, I'm going to be having guests on. Bruce Frazier is going to join me on Tuesday. Arthur Hill is going to join me on Wednesday. Aaron Swinlin, my former co-host of Market Watchers Live. We had a show on Stock Charts TV. It was their flagship show for a long time. Aaron will be rejoining me. I'll have her on as a guest on Thursday. So next few days, you'll be able to get plenty of me if you want it. Maybe you don't, which is fine too. But that comes up later this afternoon at 4. And then for Earnings Beats members, we have this Q1 earnings webinar that will start at 5 o'clock. I'm going to give you my opinion on which earnings reports coming up over the next few weeks will be the strongest and which ones I would really avoid. If you're interested in attending and you're not an Earnings Beats member, you can attend by just becoming a trial member right here. Start your no-cost 30-day trial, and we'll see you at 5 o'clock. And I do want to mention that time was moved. Excuse me. So that that webinar for Q1 earnings was originally supposed to be at 4:30 today, but obviously I'm doing the final bar show from 4 to 4:30. So we've moved it back to 5. So it'll give me a half hour to kind of get my bearings straight before we do that webinar. Anyway, hope to see you all then. Everybody have a great day. Happy trading. Take care.